We would recommend that Stephenson issue debt to finance the land purchase and maximize its total market value. In our studies of the McGinley and Miller propositions with taxes, we were provided insight on the benefits of introducing leverage to the capital structure of the firm. In this case, Stephenson is an all-equity and unlevered firm and has no debt in its capital structure. We recommend the firm choose to issue debt and become a levered firm, as the capital structure change has been proven to increase the firm's value proportionally to the level of debt of the firm. As the firm, such as Stephenson, is comprised of only equity, the firm does not gain any advantage from U.S. tax provisions that provide a tax shield directly related to the level of debt in the firm's capital structure. Therefore, the levered firm fundamentally will pay less corporate tax than an unlevered firm, which is a significant benefit as corporate taxes are a substantial cost of the firm.
Before the announcement of the purchase of land, we can take a look at Stephenson Real Estate's market value balance sheet. Since we know that this company is completely equity financed and at how many shares the company currently has outstanding, we can figure out the current market value of the firm. By multiplying the shares by the current share price of $48.50, we get a market value of Stephenson Real Estate at $582 million. On the balance sheet that we constructed, we have that market value amount for both our asset side and our liability side. Since this company is equity financed, there is no debt or liabilities that appear on the balance sheet. Our assets would equal our equity.
Suppose Stephenson decides to issue equity to finance the purchase. Before going through with the purchase, they need to evaluate if the purchase will be profitable for them. To do this, they need to determine the net present value. The net present value of a perpetuity is the initial investment multiplied by the annual expected cash flow divided by the cost of capital. The land would cost Stephenson $45 million, but bring in an expected $11 million a year indefinitely over the 11.5% cost of capital. After completing the formula, the net present value would be $50,652,173.90. Because this number is positive, we know that taking on this land would be a profitable choice for Stephenson. Next, we will take a look at the balance sheet after the purchase is announced. On the asset side of the balance sheet, we still have our old assets totaling $582 million. Next, we need to add in the net present value of the land they plan on purchasing that we found on the previous slide. As you can see, our total assets have now risen to $632,652,173. The equity now has risen as well because of the issuing of new shares, making the price per share rise to $52.72 per share. Because we issued equity for $45 million to cover the cost of the land, the $45 million divided by the new share price means we need to issue 853,566 new shares in order to afford the cost of the land. Now that we have issued the new stocks, we can see on the asset side of the balance sheet, we still have the $582 million worth of assets from the beginning, the net present value of the land, and the proceeds that we received from issuing the new stocks, having our assets rise again to $677,652,173. The equity equaling the same amount with our new shares outstanding gives us 12,853,566 shares total outstanding, with a share price of $52.72, showing us that the value of the company has gone up with the purchase of this new land and issuing only equity. last, you can see the balance sheet after the purchase of the land has been made. We have our old assets totaling $582 million, and now we have the present value of the land, which is the $11 million that we expect annually over the cost of capital, totaling $95,652,173. As you can see, our total assets has not changed. It is still $677,652,173 as it was on the previous slide. Our equity is equal to the same, with our 12,853,566 shares outstanding times our $52.72 price per share.
By using the Matalani-Miller Proposition 1 with corporate taxes, our value of our levered firm comes out to $695.65 million. Since we issued debt, we do not have a need to issue out more shares for the firm. Therefore, our outstanding number of shares will stay at 12 million. Our share price will increase to $57.97 after dividing the value of the firm by the number of shares.
The method of financing that will maximize the per share stock price of Stevens Equity is to issue debt to finance the purchase. Prior to the investment, the market value of the company was $582 million. It had 12 million shares at a price of $48.50. If equity was chosen to be financed with, if equity was issued, the stock price would raise to $52.72 per share. That's based on an additional 853,566 shares outstanding, making it 12,853,566, and due to the project cost of $45,000. If the firm instead issued debt, no additional shares would need to be added. Plus, and then factoring in the net present value of the project, the value of the firm would be $677 million, $652,173.90. Adding the tax shield brings it down to $695,652,000, which results in a share price of $57.97 per share, given that the number of shares didn't change and the tax shield was applied. Thank you. This concludes our presentation. It's clear that the share price will increase if debt is used instead of equity by over $5.25, and that is definitely a benefit to the firm, and that's due to the result of taxes applied to debt on a levered firm as opposed to using equity. Thank you.